The S&P 500 was down 64 basis points this week and closed at 3319.47. Thank you for watching this video. My name is Rodney Constable. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Today we will be doing technical analysis on the S&P 500, the Russell 2000, and the triple Qs for Friday, September 18th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. The S&P 500 was down 64 basis points for the week and closed at 3319.47. The first chart that we're going to look at is a 2-year weekly candlestick chart of the S&P 500. So each candlestick does represent 1 week of trading. And this weekly close on 9/18 today, this was the first time since the middle of July that we have closed beneath 3330 on the S&P 500. So every close that we've had since the first week in August has been above 3330. And we also, this week, closed beneath the 10-week moving average. And guys, that's the first time that we've had a weekly close beneath the 10-week moving average in the S&P 500 since right here, since clear back at the first week of April. Okay, so this weakness and the fact that we're now down 3 straight weeks in a row on the S&P 500, this is significant. Now, it will oftentimes fall down to the 40-week or the 200-day moving average. Okay, so you can see here where this arrow is at, and this orange line, that is the 40-week moving average. It's sitting right at the 3100 level. All right, so if this market continues to weaken, then a possible downside target could be right around the 3100 level. There is some support, as we see here, this blue line here at 3200, and you can see we had some overhead resistance back here that, of course, once you're above that, acts as support. You can see it again right here. And, so there's a little bit, there's really nothing back in here right exactly at that 3,200 level. But you can see, there's a few weeks where we traded right around just, right up to or just right above the 3,200 level. So there is some support at 3,200. The next, of course, major area of support will be the 40-week moving average. Oftentimes, the S&P 500 will pull right back to or around its 40-week, 200-day moving average. However, if the 40-week moving average does not hold, then the real major area of support at this point is going to be found somewhere between 2950 and 3000 on the S&P 500. And you can see here at the 3000 level, we had quite a bit of trading in this area in May and June. And you can see that going clear back into 2019, there was quite a bit of trading right up to and around the 3,000 level. And when we drop down just 50 points down to the 2950 level, this lower blue line, you can see that there was quite a bit of trading up to that area. So this means that the real major area of support beneath where we are currently trading is going to be found between 2950 and 3000. Okay, so if we continue to roll over here, again, we might stop at 3200, but realistically, guys, if the market continues to weaken here, and I think there's a high possibility, we probably will fall at least to the 40-week moving average, which again is around 3100, if not down to somewhere between 2950 and 3000 on the S&P 500. Also keep in mind, when we're looking at the possibilities of this market continuing to weaken, we are in what is traditionally the worst month of the year, September, and we're right in the worst 3 months of the year, August, September, and October. But September traditionally, technically, if you look back over the last 50, 60 years, average out all the Septembers, September is the worst month of the year for the stock market historically. We are also less than 2 months out from what will likely be a very contentious presidential election. That's going to add uncertainty to the stock market. And there's a myriad of additional reasons, including the coronavirus continuing to spread. We have no idea what earnings are going to look like on companies within the S&P 500 or the S&P 500 itself. So, guys, there's a lot of reasons why the stock market could continue to fall at least in the short term. So caution is advised at this point. The next chart that we're going to look at is a 5-year weekly chart of the IWM. The IWM is the ETF that tracks the Russell 2000 Small Cap Index. The small caps did much better than large caps this week, which is the first time in quite a while that's really happened, but we were up 2.76% on the small caps. But before you get too excited about this, I want you to really take a look at especially the last 2.5 or so years and look at what's happened at small caps. Guys, we're basically, right, this candlestick was this week. If we go to the left, we're trading almost exactly where we were at the end of 2017, beginning of 2018 on the Russell 2000 Small Cap Index. So we've been sideways with a lot of volatility in the small caps for 2.5 years. So yes, it's nice that the small caps outperformed on a relative basis this week, but when we pull back and really look at it, we've been going sideways for 2.5 plus years here, guys. So a really strong stock market needs small cap participation, if not small cap leadership. And we have not seen a really strong year in the small caps since 2017. So, we'll keep our fingers crossed that on a relative basis we continue to see this type of performance. But just understand that small caps peaked, this index peaked clear back in August of 2018. As you can see here, where I've annotated that on August 27, 2018, the IWM had its all-time closing high of 169.05. That was 2 full years ago at this point, okay? Over 2 years ago. So, we peaked 2 years ago. We've been in basically a downtrend for 2 years. We've been sideways for over 2.5 years. So just understand, yes, this week, small caps outperformed on a relative basis. However, over the last 2.5 to 3 years, the small caps have really underperformed large caps. The next chart that we're going to look at is a 3-year weekly candlestick chart of the Triple Q. The Triple Q, of course, is the ETF that tracks the NASDAQ 100 index. Of course, this is the really hot stuff in the stock market. A lot of tech, a lot of biotech, and this is, to a large degree, the area of the stock market that really led us higher after we bottomed on March 23rd of this year. We can see that the triple Qs were down 1.37% this week, and we've also had 3 negative weeks in a row on the triple Qs. The triple Qs, much like the S&P 500, are trading beneath their 10-week moving average. The triple Qs, however, have been 2 weeks in a row now beneath its 10-week moving average. Last week, it barely closed beneath the 10-week, but this week here we can see that we undercut the 10-week by a reasonable amount here. And you can also see, guys, that we're still really extended above the 40-week moving average on the triple Qs. Also, we've had 3 weeks of really high volume selling on the triple Qs. So volume does matter when you're looking at these things, when you're looking at distribution. If the distribution comes on kind of normal volume, it's like, okay, it's not that big of a deal. But when you see 3 weeks of really high volume selling, that is quite meaningful. And you can see here when we go to the left looking at these volume bars, these 3 weeks here were the highest weeks of volume, period, whether it was up or down weeks, highest weeks of volume we've seen since clear back in March. So this 3-week distribution on high volume on the triple Qs was quite meaningful. And based on the valuations that still exist on a lot of the companies that make up the NASDAQ 100, the triple Qs, we still could fall easily down to the 40-week moving average and still be trading at a pretty lofty PE ratio based on history. And also when you look at the price to sales ratio of a lot of these companies that make up the triple Qs, they are trading at very, very high valuations. So overall, guys, caution is advised. In the near term, the likelihood of downside over the next, I would say 2 to 6 weeks, the likelihood of downside is probably greater than the likelihood of upside across the board in the stock market. But as we know, the stock market will do whatever it wants. So in the short term here, though, caution is advised based on the price action that we've seen over the last 3 weeks. Before we go any further, let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and then we know that we hit the all-time high on February 19th at 3386.15. That is the closing high so far on the S&P 500. And then we had this intraday reversal on Thursday, which I talked about in my Simple Market Signals newsletter, which of course is how I disseminate the signals. And then we closed lower on Friday again. And so what we can see here is, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over, and that that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this Simple Market Signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, okay? And it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October, all right? So that thing had been positive for, 5-6 months and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. and that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page, and this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service, and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked, because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system, and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now, when you subscribe, okay, understand that everything is tied to your email on file, all right? So once you subscribe, you go out to the website, simplemarketsignals.com, and it'll take you maybe 5 minutes to subscribe. It's pretty easy, and you just follow the prompts, and then your email on file is then going to drive everything going forward. This is an emailed newsletter subscription. That's how we disseminate the information, and you should get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter that is automatically generated once you subscribe. So if you don't get that welcome letter beyond your confirmation, okay, of the subscription, if you don't get that welcome letter, if you don't see it in your in basket, then go check your spam, your junk, or your promotion folders, especially in Gmail. Having a lot of people that are having the newsletters and everything coming from Simple Market Signals going into the promotion folder. So please make sure that you check your spam, your junk, and your promotion folders. And also understand that the newsletters go out on the weekend, all right? So the goal is to get it out Saturdays by 2 p.m., but it could be any time over the weekend, depending on how long it's taken me to do the research necessary for that week's newsletter. But I try to get it out by 2 p.m. Eastern Standard Time every Saturday if I can. Again, earlier if I can make that happen. And then the next edition, right, once you subscribe, understand that the next edition, right, so if you just subscribe on a Monday, Tuesday, Wednesday, whatever, the next regular edition is going to be set out on Saturday. All right, and then once you subscribe, we will send you, as soon as we can, the latest edition, but we have to send that out manually. So just be patient with us. But again, within a day or two of your subscription, if you don't get this latest edition, then go back and check your spam, junk, and promotion folders, because it's probably hidden in there, all right? So you should get the automatic welcome letter, and then the latest edition within the next day or two of your subscription. And then again, the standard newsletter goes out every weekend, but we try to make it no later than 2 p.m. Eastern Standard Time on any Saturday.